Afternoon. This is Lauren Spidell, and I am Regional Manager, Assistant Vice President for Exeter 1031 Exchange Services. Thank you for joining me today. This presentation is regarding the fundamentals, advantages, and approaches for utilizing a 1031 exchange to accumulate wealth. And on this first slide, you will see a QR code. And the QR code, if you use a QR app or your photos, it will take you to our guidebook. And our guidebook is our most requested marketing piece. It really dives into all of the specifics on 1031 exchanges. If you have this QR code as things change or as we amend the guidebook, the QR code will still work. It's just that the information within that QR code will be updated to reflect current information. So today we're going to be discussing 1031s, and I always like to start by describing the history of Section 1031 and then going into exactly what a 1031 exchange is, why you would do a 1031 exchange, and then how to successfully complete an exchange. In order to do a 1031, you do need a qualified intermediary, and that's what we are. Exeter 1031 Exchange Services is home based out of San Diego, and we have been doing exchanges for well over 20 years. My manager and our CEO, Bill Exeter, has been executing exchanges for well over 40 years. Myself, close to 20. But Exeter is one of the very few qualified intermediaries that has any type of government oversight. And I'll get into that a little bit further on. So at the tail end of the presentation, I will discuss our company, what makes us different from our competitors, and then a little bit about our trust company, which is an important aspect to Exeter, the Exeter group of companies. So, of course, the first thing that I will dive into is the exchange history. So, a 1031 exchange allows you to sell real property that you had the intent to hold for investment purposes. Investment purposes is going to be rental income, appreciation, or something used in a trade or a business. Sell that real property and purchase other real property that you have the intent to hold for investment purposes. Again, it's going to fit into one of those buckets: rental income, appreciation, or use in a trade or a business. Prior to it actually being a code, you would see farmers barter for livestock, you would see them barter for land. So it was very commonplace, this type of give and take relationship. But the Revenue Act of 1921 created Section 202C, which allowed investors to exchange securities and non-like-kind property. And it was really coming from the Great Recession. It was designed to encourage investment and economic growth. And then in 1924, they eliminated the ability to exchange non-like-kind property. So that means that if you were selling real estate, you needed to buy real estate. If you were selling personal property, you needed to buy personal property. And at that point, the code changed to Section 112B1. In 1935, the Board of Tax Appeals approved the first modern tax-deferred like-kind exchange using a qualified intermediary. And the cash in lieu of clause was upheld, so not to invalidate the 1031. You'll hear constructive receipt of funds. That is an important aspect of Section 1031 and what our services provide. Exeter 1031 Exchange Services, being a qualified intermediary, will securely hold the exchanger's funds. If the exchanger were to sell without a qualified intermediary, they would have constructive receipt of proceeds, which would disqualify the exchange. So this is one of the huge reasons why we are required when you're doing a 1031 exchange. The Revenue Act of 1954 officially amended the federal tax code so that you could call it Section 1031. That's when it became what we know today. You may also know that Section 1031 is often called like-kind exchanges, may also be called Starker exchanges. And the term Starker comes from T.J. Starker, who was a timberland owner in the Pacific Northwest. He sold his timberland, excuse me, to a paper mill company called Crown Zellerbach. And they gave him units instead of cash. And over 5 years, if he found a property that Crown Zellerbach had, he would trade in his units for property from them. And this was done over a 5 year period. And then he filed his 1031 exchange. He was audited by the IRS. They disqualified his exchange. He paid the tax, but took the IRS to court for 4 years and eventually won. And that's when you really saw that you do not have 5 years to do an exchange. Shortly thereafter, the IRS amended the code to state specific timelines for an exchange. So you have a total of 180 calendar days to sell and to buy. But what the Starker case did do was it changed the industry forever. It demonstrated to other investors that you can do a tax deferred delayed exchange. Up until that point, most investors would sit down at a closing table and they would sell and buy within minutes or hours of one another. So it wasn't a situation of having 180 days to purchase the replacement property. This really opened up the door for specific timelines. So in 1984, the IRS clarified delayed timelines and created that 45-day identification period that everyone gets worried about, and then the additional 135 days. And I say 135 because it's a combination of 45 plus 135 that equals 180 calendar days to complete your 1031 exchange. In 1991, the IRS outlined safe harbors for qualified intermediaries to ensure compliance and constructive receipt rules. Some of the things that they added was that anyone that's provided tax or legal advice to an exchanger in the past 24 months would not be able to act as a qualified intermediary. So we are an independent third party. We will work with any title company, any attorney, any escrow company that's handling a 1031 exchange. And our goal is to make sure that the transaction is compliant, that there aren't any risks that we see. We try to be more consultative than other qualified intermediaries. So if we do see risk, we're going to let the client or exchanger know that we see risk in this scenario, and it would be up to them to decide how they wanted to move forward. Now, in 1997, the IRS clarified what is considered domestic and foreign properties. Domestic property is going to be the 50 states, Guam, Northern Mariana Islands, and U.S. Virgin Islands. So Puerto Rico is actually considered a foreign property. And then in the year 2000, there was a revenue procedure that came out that provided guidance on structuring reverse 1031 exchanges. That is definitely a transaction that people might call to learn about. It definitely has its benefits, but it is a much more complex structure. And we'll dive into that a little bit further on in the presentation. And then in, 2017, personal property exchanges were eliminated with the Tax Reform Act. So that means that if you were selling a business at that time, you could trade for another business. If you were selling artwork, you could trade for other artwork. That's been eliminated. So any personal property exchanges won't qualify for Section 1031. It's only real estate, real property. So oftentimes you'll get the question, why would you participate in a 1031 exchange? Many people know that when they own a primary residence, there is a code called Section 121. It was created in the 90s under the Clinton administration. And it allows you to sell your primary residence as long as you've lived there 24 out of the past 60 months, you haven't used the exclusion in the past 2 years, and sell that primary, defer 250, I shouldn't say defer, I should say exclude $250,000 of gain if you're single, 500,000 if you're married. Now, keep in mind, it's been many years since the 90s, and there has been discussion about increasing those numbers because we have seen values significantly increase since the 1990s. But so far, nothing's actually been put in place. But right now, you have a certain amount that you can exclude from your primary. With an investment property, you don't have something like Section 121. You're going to have tax liability if you sell an investment property. And with a 1031 exchange, you are able to defer the tax liability. So you're deferring long-term capital gains, you're deferring depreciation recapture, you're deferring possibly Medicare surcharge. It allows you to defer that tax liability and have more money working for you in another property. So there is a huge benefit. Most people average around 30% in taxes off of the gain. So it can be quite a bit of tax liability. Now, many times when I talk to investors, we talk about what are you selling for? What is the basis on the property? Many times exchangers may not know the basis. This is really where your accountant or CPA comes in, your tax advisor, to let you know what your current adjusted cost basis is on the property that you're selling. It is not just your purchase price. In some situations, it could be, let's say it was vacant land and vacant land doesn't depreciate and you didn't make any capital improvements to that land, then it could be your purchase price. But if it was an asset that was depreciated or it was an asset where you added capital improvements, then your cost basis has changed. It is not what your original purchase price is. And that number is important. It's going to really determine what your gain is. You're going to compare your cost basis to your net sales price. And that's what gives you the total gain. So adjusted cost basis is your original purchase price. You subtract all the depreciation you've taken over the years. You add back in the capital improvements you've made. Keep in mind, capital improvements are different than repairs. Capital improvements elongate the life of the property. Repairs are bringing something back to its original condition. And then you're going to compare that to your net sales price. The net sales price is the gross sales price minus routine closing costs. So broker's commission, title insurance, closing agent fees, all of those expenses can be deducted. And when you compare the two, that's what equals your total gain. Now, off of that gain, it may be taxed in different ways in different buckets. So I'm just going to give you a quick example. Let's say that you purchased a property many years ago for $300,000 and your accountant declared that $30,000 of that purchase was land value. So that's your basis because again, land doesn't depreciate. So let's say your basis is $30,000. You've got a total depreciation here of $270,000. You've taken the full amount of depreciation. Let's say it was a single family home, which the IRS allows you to depreciate that over 27 and a half years if you use straight line depreciation method, which many accountants do. And let's say that you decide to sell and your sales price is $1 million. After routine closing costs, so broker's commission, closing agent fees, those expenses, is that would be $100,000. On average, it's usually 8 to 11% off of the sales price. That's the average expense to sell in the United States. Your net sales price is $900,000. So the difference between the $900,000 versus the $30,000 is your total gain. In this scenario, you're looking at about $870,000. If you took $270,000 of depreciation, you would pay 25% of that back to the IRS. So that's about $67,500. The rest is going to be taxed at your long-term capital gains rate, which is typically 15 to 20%. In this scenario, it might kick your total numbers above a certain point where you end up being in the higher bracket. So the remaining gain of 600,000 is then taxed at, oh, I think we're going a little, I think my slide started to move. Sorry about that. Um, so with the capital gains tax, you're looking at about 120,000 being paid back to the IRS. Now, average state tax, we use 5%. There are some states that do not have any state tax. There are some states that have extremely high state tax, like California with over 13%. In this scenario, we're using 5% because that's an average rate. And that state is usually going to want the full tax liability off of that full gain. So in this scenario, it's 5% off of that 870. And then you may also be responsible for the AMT tax at 3.8%. So if you were to sell and not do an exchange, you would only have around 670,000 to reinvest. You've paid about $230,000 in taxes. With a 1031 exchange, you're deferring that tax liability. And then you've got 900,000 to reinvest. So you're usually able to buy more property, maybe better quality, maybe be able to work with different tenants. And I think it's really important to note that this is not a tax-free strategy. This is a tax deferral method. The biggest benefit is that if you have done 1031 exchanges and you've built your wealth through real estate investing, through the deferral of 1031s, eventually when you pass away, your gain goes with you when you pass. Your depreciation recapture is eliminated. So it really provides generational wealth for your beneficiaries. Let's say, for example, that you took that 900,000 and you bought let's say a $1 million property. But when you pass, the value of that property is now worth $2 million and your beneficiaries inherit that asset. They should get a date of death value. So that would be in this scenario, 2 million. If they sell for 2 million, they have no tax liability. They're able to sell. Their basis is 2 million. They're selling for 2 million. So it is a huge generational wealth planner. I would advise that you do talk to an estate planning attorney so that your properties are held in a way where your beneficiaries have that benefit and also aren't subject to probate or things of that nature. Now, with that, there are definitely certain rules that must be followed to successfully complete a 1031 exchange. This is just the list of the ones that we're going to go through. These are the main requirements for an exchange, and they pretty much cover almost everything. But there are definitely scenarios that could come up that might not be discussed in today's presentation. So when you are doing a 1031, you have to, of course, have a relinquished property. That's the property that you are selling. And your property that you're purchasing is called the replacement property. So you're going to hear those terms quite a bit in this presentation. Just be mindful that the relinquished property is the one that you're selling, and you could have multiple relinquished properties in one exchange. And the property you're purchasing is the replacement, and you could have multiple replacements in your exchange as well. Now, to get started, on this slide, we talk about our services as a qualified intermediary. I think that the first step is really having a discussion with your accountant or CPA to find out what your tax liability may be upon sale. There might be a situation where you might have losses that can offset gain, and now it may not make sense to do an exchange because you might not have tax liability if you sell because those losses can offset that gain. The transaction that we're working on is just a sliver of your overall tax return. So we only know what you're sharing with us, and we only know about the transaction at hand. We don't know any of your other tax situations. So it's always good to talk to your accountant before you sell an investment property and have an idea of what kind of tax liability you might have should you sell. If you do decide to sell, you may decide to hire a realtor or a real estate agent to assist with the sale. Once you have a signed contract, that is a perfect time to set up an account with a qualified intermediary. And that's what we do. So we are often called a QI or 1031 exchange accommodator, a 1031 exchange facilitator. They're all one and the same. So prior to closing, we have to set up your exchange account. So we are going to draft the necessary exchange documents for you, the exchanger, as well as the closing agent so that they have our instructions. We are going to set up a qualified trust account to securely hold the exchanger's funds, and we're going to help advise and help structure. So if we set up the transaction and for some reason the title commitment doesn't have that exchanger on file, let's say it's a trust or an LLC, an entity, we may require additional information to figure out who exactly has been reporting this property for tax purposes. Now, the qualified use requirement is a very simple requirement. It means that you must be able to prove, if you were audited, that you had the intent to hold both the relinquished and the replacement property for investment purposes. So again, those three buckets is going to be rental income, appreciation, or something used in a trade or a business. Usually, most exchange accommodators will recommend that you hold the property for 12 to 24 months because then that asset is typically reported on your tax return for 2 or 3 tax years. So if you were questioned about intent, you could easily prove you had the intent to hold because that's exactly what you did. Property held for sale will typically not qualify for exchange treatment. So fix and flippers don't qualify. Their intent usually is not to hold, it is to fix and flip, it is to sell. Condo conversions or changing the structure of an asset from rental units to condos, let's say, typically that is updating the property and then selling it. Property acquired to develop, so developers typically don't qualify for exchange treatment because their intent is not to hold after they develop. Keep in mind, there are always different scenarios that can change this. The IRS realizes that intent can change. So you could have a fix and flipper where that's all they've done, but for whatever reason, they decide to start renting the property. If they start renting the property and now they can show that it's been an income producing asset for, let's say, a year or two, now they can qualify for exchange treatment. So everyone's scenario might be a bit different, but you want to be able to easily prove you had the intent to hold. Now, as I mentioned, there's no specific or required holding period. It's just that if you are able to easily prove you had the intent to hold, you're in a very good position. Keep in mind that income is not required in order for it to qualify for an exchange, but it may help to prove intent. So let's say, for example, you bought a condo, but you decided that you didn't want to rent it. You wanted to hold for appreciation. You definitely want to make sure there isn't any personal use. But if you could rent it, that's going to just help prove intent. And as I mentioned earlier, most QIs will recommend holding the property for 12 to 24 months because it straddles multiple tax years. With that, the like-kind requirement often comes up. People will call and ask if they're selling a single-family home, must they buy a single-family home? And I think the confusion comes into play with the personal property exchanges that were available to us prior to 2017. Those types of exchanges were very specific. If you were selling a fleet of cars, let's say an enterprise was doing an exchange, selling a fleet of cars, you'd have to buy a fleet of cars. UPS, for example, did one with a 747 for cargo planes. They ended up purchasing 747 to basically fly executives to different locations. They were audited by the IRS and they were disqualified because it was not used in the same fashion. With a 1031 exchange, as long as you meet the qualified use test, real property is like kind to other real property. So property that is, here's a list of them. Single family, multifamily, office, retail, industrial, vacant land, those are all real property. So you can trade into one of those types of assets. Some lesser known would be oil and gas interests. That's actually considered real property. Mineral interests, air and water rights, fractional ownership, and a passive investment. So there are a couple of passive investments that qualify as well. They are called syndicated tenant and common structures and Delaware statutory trusts. These are investments. So you would need to go through a financial advisor or DST broker. And what they do is they make sure that the investment is suitable for you. It's required by the Securities Exchange Commission to make sure this isn't, all of your retirement going into some sort of passive real estate investment. But it is like kind to real property. So if you are someone who doesn't want to actively manage property any longer, and we do see this, you might want to consider a fractional ownership in one of these securities. Prior to working at Exeter, I worked for one of the largest DST sponsors in the nation. And what these companies do is they are typically nationwide real estate companies. They go out, they buy real estate, typically in all cash because you'll get a better sales price with it or purchase price. They may then add some leverage onto it, and then they wrap it into a wrapper. So either a tenant in common structure or a Delaware statutory trust structure. They are similar, but also different. The tenant in common structure, you have a max of 35 investors. Everyone has voting rights. Usually the portfolios are smaller because you're only raising equity from 35 people. Typically, everyone has to create an LLC. There's a cost to that, of course, and everyone is also being underwritten by the lender. With a Delaware statutory trust, you can have almost 2,000 investors. So they typically have larger portfolios. With that, you do not need to create an LLC. You're going to own a beneficial interest in the trust. You don't have any voting rights, which is sometimes hard for people who have actively managed real estate. You do not decide when this portfolio liquidates. So the average investor age into one of these is around 70 years old. And that's typically because most people going into something like this are at a stage in their life where they don't want to deal with the headaches of actively managing real estate. So if you are at a point within your exchange period, let's say that you're nearing your 45th day and you haven't found a replacement property, you certainly could choose to go into something passive like this. We can provide you with some DST broker referrals if you don't have one, and they can discuss what's currently available. There's about 70 different sponsors right now in the market, so there is quite a bit of options available to people. Non-like-kind property, that's going to be personal use assets. So your primary residence typically doesn't qualify. Second homes and vacation homes can qualify. That's going to be my next slide. Property held for sale, so conversion, development, fix and flips, like we mentioned before. Securities, so cash, stocks, bonds, mutual funds, and REITs. That is not real estate. Real estate investment trust is shares. So that's definitely something that comes up quite a bit. Equity interest, so partnership and membership interest, LLC interest, or shares in a corporation. Those entities can do an exchange, but you cannot sell real estate and buy shares in a corporation or membership interest in an entity because that is personal property. Now, vacation homes and second homes can qualify with proper planning. Most of the times when people come to us with a vacation property or a second home, it might be snowbirds who 6 months out of the year, they live in the northern part of the US, and then 6 months out of the year, they live in the southern part of the US. And that would be excessive use from an IRS perspective. In 2008, there was a revenue procedure released that gave us additional guidance on these types of properties. And the property that you are selling or the property you're purchasing can be a second home or vacation home if, for the last 2 years or the first 2 years, depending on which property it is, it must mostly be investment. So that means that you've got to rent the property out for at least 14 days each year at fair market value rent and report that rent on your tax return each year, the last 2 years or the first 2 years. And you must also limit your personal use to 14 days or 10% of days rented, whichever is greater. And that personal use is each year, the last 2 years or the first 2 years. So really the IRS wants to see that you're not just staying there, using it and just renting it a couple of days. They want to see that it's mostly investment use. If you are using the property to make repairs or improvements to get it ready for the next renter, that shouldn't be used against your personal use, but I would definitely keep record of it. so that you know what was being done while you stayed there in case that were to come up in an audit. And before we go to our next slide, I just want to mention too that there is also a Q&A section in your Zoom. If you do have any questions, I'd be happy to answer them throughout the presentation or even at the end. And there's also a chat feature as well if you want to throw questions in there. So if any questions come up, please don't hesitate to use those two features. The reinvestment requirement is often the most misunderstood requirement of Section 1031. We have exchangers that will call and think that they only need to reinvest their gain or they only need to reinvest the cash that they receive at closing. In order to have a fully tax deferred exchange, you have to remain fully invested. So that means you're trading equal or up in fair market value based on the net sales price of the property you sold. That means reinvesting all of your cash equity and reinvesting the debt amount that's paid off at closing if you have debt. You can always add cash to a purchase. But if you were to not reinvest all of your cash and let's say take a larger mortgage, that portion of cash that's not reinvested would be taxable. So I'll give you an example. Let's say you sell a property for $530,000 and after routine closing costs, your net sales price is $500,000. You have a mortgage of $250,000. That mortgage would be paid off at closing. The other $250,000 would come to us. We will hold it for you to reinvest that into a replacement property. Your goal is to reinvest all of the $250,000 that we're holding and purchase for $500,000 or more to have a fully tax deferred exchange. So that means you're replacing that debt somehow. You're either replacing it with another mortgage or you're replacing it with cash. Sometimes people have very small mortgages and they decide that they just want to bring cash to the purchase and not take out a mortgage. As long as they're buying in this scenario for $500,000 or greater, they should have a fully tax deferred exchange. You could always do a partial exchange. It's really important, though, that you check with your accountant to make sure that if you take out too much or don't reinvest too much, that it still makes sense to do the exchange. So pulling cash out or trading down in value will result in what we call boot. And there's two types of boot. There's cash boot and there's mortgage boot. Cash boot would be if you were to take cash at closing or not reinvest all the cash that we're holding. Mortgage boot would be if you don't replace the value of your debt. Let's say you had a mortgage of $250,000 and you replaced all of your cash, but you took out a mortgage for $200,000 instead, meaning you bought for $450,000. There's $50,000 there that hasn't been reinvested. So that would be mortgage boot. With that being said, it's the investment concept of first dollar in, last dollar out. So any amount that is not reinvested would have tax liability until all of your gain is taxed. And then you would be able to get to your equity without paying tax. And I just got a warning that my computer is about to die and it's plugged in. So if you don't mind, I'm going to go ahead and switch real quick to a different plugin because I don't want to disrupt this. I'm so sorry. I don't know why that happened, but of course it did. So I apologize. I am trying to get access to the PowerPoint slides and it's not letting me move them. Okay, there we go. Let me just go back a little bit. Thank you for your patience as I was able to get my computer back up and plugged in. So it's the investment concept of first dollar in, last dollar out. So again, any amount that is not reinvested would be considered gain before equity until all of your gain is taxed, and then you can get to your equity. Now, when we talked about routine closing costs, this is just an example of permissible and non-permissible selling expenses. So most of your expenses are going to be permissible. And on that QR code on the first page, on page 19, you will see a list of them. If you wanted us to review your estimated settlement statement, we certainly could do that. We can review it to see if there's anything that might be non-permissible. If you had any non-permissible expenses, and you used your proceeds from the sale to pay for those non-permissible expenses, that would cause tax liability. It's literally as if the closing agent is giving you cash, you're turning around and you're paying an invoice. So that would be constructive receipt of the funds, hence that would be taxable. Um, so financing costs, prorated property taxes, prorated rents, insurance premium payments, security deposits. If you wanted us to pay off a credit card, if you wanted us to pay for a repair or maintenance cost, HOA fees, those are all non-permissible expenses. Most people are fine with the closing agent just deducting from the proceeds. But if you really wanted to have no tax liability at all, you could bring out-of-pocket funds to closing to cover those expenses. The same taxpayer requirement means that the same taxpayer that's owned and seasoned and reported the relinquished property should be the same taxpayer that purchases the replacement property. So if I was the owner of a property and I've been reporting that property on my tax return, and now I want to move forward with purchasing a replacement, and I'm all we're doing is buying another property for, let's say, same example, 500,000, but this time I'm adding my adult child onto that purchase. Now you've got an issue because now the question is, did you reinvest everything or did you possibly gift some of that property to an additional person? There's also questions about if I own a property in my trust, can I buy my replacement in my name or can I buy it in an LLC? If the entity that owns the relinquished property and reports that property is disregarded for tax purposes, so it doesn't file a tax return, it doesn't file an 1120S, it doesn't file a 1065, it doesn't file a trust return, then you're one and the same with that entity from a tax perspective. And that would mean that that entity is disregarded for tax purposes. So you could sell in that entity and buy in your name or buy in another entity that's also disregarded because it's all using your social security number and you should be fine. If the entity that you own is a regarded entity, so let's say it files a 1065 partnership return, that LLC is the taxpayer and that LLC will need to sell and will need to buy. So every scenario is different. We certainly can discuss different scenarios with clients and walk through how they own, what's reported on title, what entity is actually reporting the income and expenses. Is it an individual? Is it a trust? That's something that we need to know as we structure the 1031. Now, our most favorite topic is total exchange period. We need to be assigned into the sale prior to the closing of the relinquished property. So if closing was today, you must have set up your exchange account prior to today. And then you would have 45 calendar days to formally identify possible replacement properties. We give the client an identification form, and they're going to use that to formally identify. And then after the 45th day, they have another 135 calendar days to close on something that they identified. During the 45 days, you can amend your form as many times as you want. You can even rescind it and decide you no longer want to do the exchange. But once you have reached midnight on the 46th day, there's no amending that form. So if you miss that deadline and don't submit an identification form, we're releasing proceeds to you. It's a regular taxable sale. If you identify a few properties and come day 80, all of those have fallen through, you're going to be in a scenario where you're going to have a taxable transaction because you're not buying something that's listed on that form. When you identify, you're not able to list anything you want. You have to follow an identification method, and there are three methods. On the identification form, you have to choose an identification method. And the most common method is called the three property rule that allows you to list three potential replacement addresses. It may not mean that you plan to buy all three. You may only choose to buy one, but you're listing, let's say, two additional for backup. If you wanted to list more than three, you could, but you'd be restricted in other ways. So, for example, let's say that you decide to use the 200% of fair market value rule. That means if you sold the property for $1 million, you could identify $2 million worth of real property. Let's say you list four properties, each for 500,000. This would work because the total aggregate value doesn't exceed $2 million. So this rule is great if you know that you want to break the funds up into multiple replacements or smaller value properties. You might have a large commercial building, but want to cut that up into multiple condos or multiple single family homes. This might work for you. The 95% exception allows you to list as many properties as you want, but you've got to close on 95% of the value listed on the form. So I would only recommend that if you buy everything within your 45 days, or you are buying a portfolio and you know that you're going to be able to purchase everything within that portfolio. Keep in mind, you do need to be specific. So you can't just say a condo in San Francisco. You have to provide an address, a unit number. If there was a condominium building, you can't just list the condominium because the IRS could take it that you were going to purchase the entire condominium complex. That identification form should be sent to the qualified intermediary prior to midnight on the 46th day. So you'll have all the way up until 11:59 your time zone to amend or even rescind your form. Now I'm going to go a little bit into the weeds with this next slide. This is talking about taking a rental property. So under the Housing and Economic Recovery Act of 2008, the IRS came out and said that you could take a rental property and convert it to your primary residence, but you'll want to rent the property out for at least 24 months. And you will want to then move into the property. In order for you to qualify for Section 121, which is what I mentioned in the beginning of the presentation, the 250 or $500,000 exclusion, you would have to own that property for at least 5 years. That's something that normally is not required, but it is because this is part of a replacement in an exchange. And then if you sell it, you're able to take the gain and prorate it based on the number of years the property was used as a rental versus primary. So I typically tell people that if you plan to move into your replacement property, the longer you live there, the better. Ideal case, at least for your beneficiaries or tax-wise, would be that you live there until you pass away. And then at that point, your basis goes with you, your gain goes with you, and now your beneficiaries receive that step up in basis. With that, the scenario I often give people is, let's say you rented it for 3 years and then you moved in it and lived in there for 3 years. You've satisfied the exchange. You satisfied Section 120, Section 121. You've lived there 24 out of the past 60 months. You have owned it for over 5 years. You've owned it for 6, and you haven't used the exclusion in the past 2 years. Half of that, because it's half rental, half investment time, half of that gain is going to fall under the exclusion, Section 121, and the other half would have possible tax liability. Keep in mind, the 121 exclusion does not shelter or defer or exclude any depreciation recapture. So that may still be due upon sale. We also may see scenarios where someone has lived in a property long enough and they're in an area where the values have increased significantly. So now they go to sell and they realize we're going to have a real large tax liability. They may decide to move out of the property, rent it for 2 years to prove that they had the intent to hold it for investment, and then sell within that 5th year so that they still qualify for Section 121. And they'd be able to take the exclusion, let's say the 250 or 500,000, and put the rest into a 1031 exchange. So that's really for someone whose gain is significantly larger than 250 or 500,000. Uh, One other thing I want to mention is that if a property was partially held as investment and considered to be one dwelling, one structure with one common entranceway, you could elect for Section 121 for the entire property. I would definitely talk to your accountant to see if they also agree with that, because they're the ones that are going to file your taxes and determine what tax liability you might have. So there's other ways to use Section 121 and Section 1031 together. Now, what I've just described is the forward exchange. Sometimes we call this a simultaneous or delayed exchange. A concurrent exchange is the same thing as a simultaneous. You're doing it all on the same day. Delayed exchange means that you have a day in between the sale and the purchase. But ultimately, you're selling first and you're buying second in that order. A reverse 1031 exchange always sounds fantastic, but it is definitely more complex. It's more costly. There's a parking arrangement in place. So we would act as an exchange accommodation title holder, and we need to park title to one of your properties, either the replacement or the relinquished property. And that's because you're not able to own both properties at the same time. Most of the time, we're parking title to the replacement property. And then you'd have 45 calendar days to formally identify what you're selling. We typically already need to know what that is when we structure the reverse. And then you'd have another 135 calendar days to sell. It can become complex when you are not able to purchase the replacement with all cash and you need to use a lender. If you are using a lender, lenders do not love this transaction, so you're really probably going to a hard money lender, a local bank, a credit union, some sort of institution that services their own loans. We would require a call with the lender earlier rather than later because we don't want to be in a situation where we're getting close to closing and then we find out the lender isn't willing to work with us. We can park title to the relinquished property, but there are some specific requirements for that as well. But ultimately, the cost, the complexity of a reverse is much more expensive. You can also do an improvement or construction exchange, and that would be where you purchase a replacement property and you still have funds to use to make capital improvements to the property. There is a parking arrangement that needs to be structured in this scenario as well. We would park title to your replacement, you're named construction manager, and you're using your proceeds to make improvements to that property within 180 calendar days. So you still have the same timelines. You have 45 days to identify that new property and the improvements you plan to make. And you really want to get as much of that completed as possible. Towards the tail end of your exchange period, we recommend taking pictures or video of what has actually been completed, because if you were audited, you'd have to prove that everything was completed with those exchange funds by the 180th day. So if you needed 20 grand of roofing and the contractor just threw it in the garage of the property, that's still personal property until it's actually fixed to the real estate. So that portion would not qualify for an exchange and you'd have some tax liability in that scenario. And then we also do foreign property exchanges. There's only a handful of us that do foreign property exchanges. We're one of maybe 5 companies. Foreign property is like kind to other foreign property. So if you are selling in Mexico, you could buy in Canada. If you're selling in Canada, you could purchase in Spain. You just can't purchase in the US and you can't sell in the US and buy foreign property. That is considered non-like kind. Protecting your exchange funds is extremely important. So we are part of the 1% of qualified intermediaries that has any type of government oversight. Exeter 1031 Exchange Services have been acting as a qualified intermediary for over 20 years. In 2019, we created Exeter Trust Company, and I'll explain that in just a moment. But we do have extensive experience and expertise to assist you with your exchange. We carry 10 million errors and emissions insurance, 10 million fidelity bond, 10 million cyber and wire fraud. We also have a blanket bond, 5 million general liability. We can provide insurance binders and you can certainly call to verify coverage. Again, we are part of the 1% of qualified intermediaries that has any type of government oversight. The trust company is the entity that receives funds. It sets up a qualified trust account for every exchange client. So that means that your funds are legally protected. To become a trust company, you have to have enough capital reserves to act as a trust company. You are audited every 18 months. You have to have regulatory exams. If you are audited and there's an issue, you can be written up. You could have fines. You could lose your trust charter. So there's significant repercussions by not following the requirements of a trust company. With that, the trust company also requires a signature from both the 1031 exchange accommodator as well as the client to move any funds. So it's not like one person has their finger on the release of funds button. It actually takes four separate Exeter employees to release any funds. And then because we're a trust company, the funds are automatically spread through 12 banks. So you receive $3 million of FDIC insurance. If you wanted more, we are part of the Insured Cash Sweep program, which provides up to $150 million of FDIC coverage, in case that's something that interests one of our clients. Now, Exeter Trust Company was established in 2019. It was established to not only provide qualified trust accounts for clients, and the reason why we use qualified trust accounts is specifically based off of a bankruptcy case involving a qualified intermediary. There was Land America, and they ended up taking client funds and investing them into auction rate securities, which are typically very secure. But in 2008, we all saw the market crash. They lost exchange funds. And the bankruptcy judge ruled that if the funds had been held in a qualified escrow or qualified trust account, they would have been legally protected and earmarked as those client exchange funds. So it took about 10 years for clients to get their funds back. So that is one of the reasons why you would want a qualified trust account to hold your funds. We also can do land trusts. We can do specialty escrow holding accounts. And we also act as a custodian for self-directed IRAs and self-directed 401ks. So the Fidelity and Charles Schwab's of the world usually do not hold real estate or alternative investments on their platform. We do. So if you wanted to diversify your retirement, you could purchase real estate in your self-directed IRA. You could purchase private equity, alternative investments, non-traded REITs, mortgage and promissory notes. There is a list of different types of investments that we can hold on behalf of investors. And our last page is just contact information for me. You'll find my direct phone number there. You'll also find my direct cell phone in case you want to call or text. Our corporate headquarters is available 24/7. So if you call 619-239-3091, let's say your 45th day ends on the 4th of July and you need to make sure that someone receives your form, you can call that number. And there's about 7 of us whose phones all ring at the same time. If you ever get a voicemail, I recommend hanging up and calling back. My email address is there, our website is there, and then on the left-hand side, you'll find a QR code with my contact information. So if you're using your cell phone for that QR code, you can save that into your phone. And then on the right side, again, is our guidebook. That, again, is our most requested piece. If by chance you wanted hard copies of that guidebook, you would just let me know and I could mail them to you. We also have quick reference guide, which is a shortened version of the guidebook. But at this point, I'm going to open up for questions. The way to submit a question would either be through the chat or through the Q&A feature. Any questions that might be specific to you or to specific to the 1031 exchange or the maybe combination or some of those more complex structures. I'm going to pull up my Q&A right now. So there was a question about your primary residence qualifying. So if it is your primary residence and you're currently living in it, it would not qualify for exchange treatment unless, let's say, it was a fourplex and 1/4 of the property was your primary. You would be able to take Section 121 on the portion that's the primary, but the other 3 units, could qualify for 1031 exchange treatment. With that being said, you can, of course, move out of your primary You could make it an investment property and have that investment income be reported on your tax return for 12 to 24 months, which is typically straddling 2 or 3 tax years. And then it could qualify for exchange treatment. So there are ways in which that could possibly qualify. Hopefully that answered that question. Like kind, there's a question here about like kind again. Like kind means that it is real estate to real estate as long as you have the intent to hold the property for investment purposes. So, property that you have purchased with the intent to sell does not qualify. Property that you had the intent to use as a primary will not qualify. Usually, second homes and vacation homes don't qualify unless you fit nicely into those safe harbor requirements. But real estate is like kind to other real estate. So you could be selling commercial property and be buying residential. You can be selling residential and buy commercial. And then, of course, there are some other real estate um, like oil and gas interests, mineral interests, air and water rights. Those passive investments all qualify as well. So I will just leave it open for just a few more minutes to see if anyone has any additional questions. If you do, please don't hesitate to put it in the chat or to place it in the question and answer section. If you feel like I've answered all your questions, that's fantastic. You can always reach out to me directly. You can contact me with the numbers on the screen. And there I will end the webinar. But if you need anything, please don't hesitate to reach out to me directly. Thank you all for joining, and I hope that we can work with you in the future.